Hello, it's Kurt Jackson, Certified Mortgage Planner in Liberty, Missouri. I'm here today with the next installment in our educational video series. And today we're going to cover what we feel are really the top 10 mistakes that you may have made when you got your current mortgage or will likely make when you get a new mortgage. Number one is that you bought a house beyond your means. In today's society of keeping up with the Joneses, most of us buy a house that's much bigger than we really need. You know, the average size house has grown from about 1,500 square feet back in the 70s to almost 2,400 square feet today, and our families are smaller. So it appears that most of us do this to maybe impress others or to maybe stroke our own ego. But folks, by purchasing a less expensive house, it can save you tens of thousands of dollars in mortgage payments that could be redirected towards long-term planning such as retirement and college funding. Number two, you wait until the last minute to apply. You know what, like everything else in life, if you wait until the last minute, you didn't have time to research what you were doing and to ensure the best program that you got for your family. When purchasing a home, you should start the process with your certified mortgage planner, not the realtor. And after you've analyzed your goals, your dreams, and your finances, you then enlist a realtor and you have a personalized mortgage plan in hand to help you find your home. By doing it the other way, like most do, you were probably rushed into a decision and acted out of impulse or emotion and not from sound thinking. On refinance transactions, you wait till you can no longer pay your bills or late notices are piling up, and by then it's probably too late. Now, if you'll implement a review as in number 5 below that we share with you, you can take control of your financial future. Number 3, you have a 30-year fixed rate mortgage. You know, the national average for time we stay in our homes is 7 years. The national average for a mortgage is about 4.2 years. Fannie Mae, which is one of the largest purchasers of mortgages, has said that 80% of all mortgages are paid off within 5 years. That means the house was sold, refinanced, or they actually paid it off. So 80% in 5 years, 90% in 7 years, and 99% in 12 years. Yet you probably still took out that 30-year fixed rate mortgage or a 15-year fixed rate mortgage. You know, if you shorten the term of that fixed rate period by getting an adjustable rate mortgage, you can save money with a lower interest rate. You can create additional cash flow to invest towards long-term growth. The key, though, is that you've got to invest the difference of what your 30-year fixed rate mortgage or your 15-year fixed rate mortgage cost versus what your payments would be with an ARM. If you don't do that, you will not build wealth. But that is another way to build wealth by reinvesting those savings. Number 4, paying down the principal balance of your loan. First, folks, you got to realize that money you pay towards the principal balance is money that you're not going to see again until you sell the house or refinance it. Second, equity in your home has a 0% rate of return. Now, I know that having a lower mortgage payment gives you some savings in your monthly payments, but that savings does not enjoy the power of compounding interest. In addition, each principal payment you make reduces your tax deductions. Each principal payment you make exposes you to greater risk of liability and market downturns. Each principal payment you make reduces your chances of qualifying for financial aid for college tuition. Each principal payment you make provides you with less liquidity. Each principal payment you make reduces the money that could have gone to other investments, and each principal payment you make transfers the risk from the bank to you. So every time you pay down your mortgage, there's less risk for the bank and more risk to you. Number 5, you fail to review your mortgage every year. You know what, folks? Life happens. Your circumstances can change each year. One spouse may have stopped working or went back to work. You may have gotten injured or possibly laid off. Maybe you ran up some debt. Your credit scores may have improved, opening up better programs that might not have been available to you when you took out your current mortgage. Maybe you want to make improvements to your home. You got to pay for college. A mortgage checkup can also help prevent identity theft through a credit check, so it's key to do that once a year. Number 6, rate was the most important feature. You know, this is one of the most common misconceptions people make when they look for a new mortgage. Rate is not the most important feature. Monthly payments, right program, maximizing your monthly cash flow are much more important. Now, rate does determine the payment, but folks, how you structure your mortgage, how your overall debt is handled, how long you will use the mortgage, how much down or equity you keep, what your long-term financial needs are. If you're going to are you maximizing your tax deductions? Is your cash flow optimized? And do you have a plan for that cash flow? All of those things is going to have a much greater impact on your overall financial success than the rate you get it. So folks, think about this. In the top 10 most important factors in getting a mortgage, rate comes in at number 9. There are at least 8 things that are more important than rate. yet you likely made your decision based on rate. Number 7, I'm doing okay, so why should I do something non-traditional? Even if you feel you're doing okay, by whose standards are you doing okay? So don't rationalize where you are. Even if you're doing great by properly structuring your mortgage, there's an excellent chance that you could do even better. If you're not where you want to be, then you should look at alternatives. The goal is to have a very rich retirement, and using a mortgage correctly can turbocharge your lifestyle during the retirement years and actually protect you along the way, you and your family along the way. Number 8, I was too busy to consider alternatives, or I'll worry about that later. You know, most Americans spend more time planning their family vacation than their financial future. What you're really saying is that you don't want to learn anything new, or maybe you're financially embarrassed about where you are today, so the less you talk about it, the better you will feel. Folks, this is why 95% of Americans will not be able to successfully retire. It's exactly why the average 45-year-old has an average of only $27,000 set aside in retirement accounts. This is exactly why 33% of Americans have no retirement savings. And it's why 55 to 64-year-olds have an average of only $56,000 in their retirement savings. This is why we as a country have a negative savings rate. It means we're spending more than we make. By not thinking about these things and planning for them, that's where all of these mistakes happen. Number 9, you made a large down payment or kept a lot of equity in the house. Perhaps it should have been number 2. We had some arguments over that, but we put it here. But we talk about this because most of us think that a large down payment or having a lot of equity will save us money over the length of the mortgage. The problem with that is we'll give you some savings, but the more you put down or the more equity you have, it just means that you're going to have that much less available out there working to build, to create wealth. That could be in other investments that are enjoying the power of compounding interest, in addition to the pitfalls that we talked about in number 4. Number 10, thinking it's just a mortgage. You know, a mortgage today is more than just a mortgage. Today we see a mortgage as a financial instrument that should be tied to both short and long-term financial goals. The type of mortgage you have dramatically affects your net worth and directly impacts your ability to retire. I want to share with you a very telling quote from a lady by the name of Karen Ferguson, and she's the director of the Pension Rights Center. She said, "It's an untold secret. You can work a lifetime and do everything right and not be able to pay your bills in retirement." Folks, this is what we're talking about when we do what we do. We're trying to help people realize that and prevent that. What happens is most of us follow what those before us have done. But what we must not fully comprehend is that those that we are following, for the most part, have failed miserably in planning for the future. And for those that maybe in your eyes have had some success, are using tools such as pensions and Social Security income that we're not very likely to have fully available to us in the future. Here's a question for you. How many people that you know that are in retirement can do whatever they want in retirement? Now, isn't that the true definition of retirement? Being able to do whatever you want to do in retirement without having to worry about money or anything? Well, folks, the good news here is that our advanced mortgage planning strategies can help you use your mortgage to create wealth and peace of mind. So if you're interested in exploring this a little further, just contact us using the information that's on your screen. Thanks for tuning in. If you know of anybody else that might benefit from this information, please forward the link to them. We want to share this information with as many people as we can. Thanks for tuning in. Have a great day.